Yeah, welcome. Welcome everybody. Welcome to Bell TPO. We are hosting this webinar uh, on order flow today. This webinar is being recorded. So this is the third part of the 4-part webinar series which we are conducting, and today's webinar is on order flow, getting the timing right using order flow. Myself, Dean. You can get in touch with me on my website, getthattradingedge.com. Let me first go through the disclaimer. Information shared here is not a trading recommendation, and we are not in a business of providing any. All information shared here is strictly for educational purposes only. Please use your discretion while acting on the information shared here. We will not be responsible for any resulting profits or losses. Please consult your registered financial advisor before you make any trading and investment decision. A small note before we get into the presentation. In case of any technical problems during the webinar, we will reschedule it at a later date and you will be informed accordingly. Please post your queries in the chat window during the webinar. I would cover them at the end of the presentation if time permits. Else, they will be covered in separate Q&A sessions for the Slack group members. You will be getting a Slack group invite if you haven't got it already and you are attending for the first time. This webinar is recorded and will be available for a limited period of time on the Slack group. And you can also get access to these webinars on belltpo.com. But this will be for a limited period of time. Later it will be only available to Bell TPO customers. So make the most of it while it is available. Okay. So what is the objective for today's presentation? We are going to use order flow to identify where buyers or sellers might be accumulating or distributing in the market. We'll also use order flow to confirm opinions arrived at by using traditional technical analysis, or TTA as I call it, or market profile, whatever is your choice, about the current state of the markets. Means that once you say that, okay, I find this particular support will hold, or this resistance if taken out, the market should shoot up. Now that is your analysis. But what we can do is we can use order flow to confirm whether what your analysis is telling you is actually happening in the market or not. Thirdly, we'll be finding good entry points to create positions in the markets. Now, market profile is all about context. I'm not a very big fan of traditional technical analysis, but that too should be used to provide context. And whenever you try to use these tools for purely timing purposes, many of us have faced that problem of getting in at the wrong time and then market just moving enough to push you out of the market to hit your stop loss and then again continuing in its intended direction. So what we can do is we can use order flow to avoid this, to get in the market at the right time, provided that your context which you have gathered from other technical tools is correct. Okay. Yeah. So what is order flow? Have I missed a slide? No. What is order flow? It is the real-time display of all the buy and sell orders at any given point in time in the markets. Now, mind you, these buy and sell orders are the executed orders. Whenever you press that snap quote window on your broker terminal, you get 5 best buys and sells. Those 5 best buys and sells are pending orders. Those are not the executed orders, but the order flow charts will always show you the executed orders at any given price at that particular time. So if more buy orders were executed at a given price than the sell orders, then we can say that demand was strong there and supply was maybe weaker than what buyers were trying to do. So a buyer bids for buying an instrument at a given price, whereas seller asks a price for that instrument. Now, many a times, if nowadays you have this bid ask words being used everywhere. and especially in the context of the order flow chart. So bid ask is nothing but buyer asking for a bidding for a product or an instrument is called as a bid price, whereas seller saying that I want this much price unless I won't sell this product, that price is called as ask price. So whenever we have these prices matching, that a buyer bidding for an instrument for a particular price, and for that particular price only a seller is willing to sell, and when these prices are matched we get a trade, and that particular trade is reflected on an order flow chart. Now which side of the order flow chart this trade will appear depends on who was the more aggressive participant. Aggressive participant means who was putting an market order in the for that particular instrument at that particular price level. So whoever is putting in a market order will get that particular quantity printed in his area of the order flow chart. So if a buyer is putting in a market order, that particular number will reflect in buyer column, and if a seller is putting in a market order, that number will be reflected in the seller column. So a few definitions, I have covered this. Okay, no definitions. So ask price. Price at which a seller is ready to sell is an ask price. So whenever you go to any shop and you find that MRP written on that any product, that is an ask price at which seller is ready to sell. Bid price is the price at which buyer is ready to buy. So sometimes there is a negotiation which goes on when you enter into a deal or a trade. So it's not that when a seller is selling saying that he sell at a particular price, the buyer has to agree at all times. He can say that, okay, I am not ready to buy at what price you are selling. If the seller is asking for 50 bucks, he say I would buy this but at 40 only. So that 40 will be the bid price by the buyer. Ask volume is if we go and buy that particular product or instrument at 50 at which the seller was asking, then the trade is happening as per the wish of the seller, and that volume we will call as ask volume or seller volume. Similarly, if the seller drops down and sells the product to you at 40, then the trade is happening as per the buyer's wish, and then we will call it a bid volume or buy volume. And for any price, the difference between the buyer volume and seller volume is what we call as delta. Now delta can be calculated at price levels, individual price levels, or for the complete day, or for a time period, say for 30-minute candle you can calculate delta. So delta can be calculated on various ways and can be displayed on the charts. So how many type of orders are there really? Broadly, there are three types of orders that affect the order flow for any instrument. First is the market orders or the aggressive orders. Second one is the limit orders or the non-aggressive orders. Third one is the passive orders or orders which are not yet in the market. Now, what do I mean by that? Market orders, we all know that whenever we buy at market, most of the times we are in a hurry. Now we might be in a hurry because the market is running away from us. We might be in a hurry because our stop losses are getting hit. So the reason might be anything, but whenever you are in a hurry, you try to enter a market order. At market order, you want your order to be executed at all costs, and you are not really bothered about what price level it is getting executed at. Now, this particular behavior where you are in a hurry to get your orders executed are called as aggressive orders, because then you are not bothered about the price. You just want to get in or out of the market, and you are just pushing your orders in the market and not worried about the levels of execution. But limit orders are not like that. Why we call it non-aggressive orders is because you will put in a order at a price which you feel is fair. Suppose taking the example of Nifty, if Nifty is trading at say 8,500, and you feel that 8,500 is not a fair price. I want to buy Nifty, but I would buy only at 8,400. So what you can do is you can go into the market, put in a buy order at 8,400. Now, since market is trading at 8,500, 100 points away from your price, your order won't be filled immediately unless the price, travels back to 8,400 levels. And when it comes to your level, your orders will be executed. Now, what will happen? Uh, we all have heard about this pullbacks in a move. So suppose Nifty was rallying, it went to 8,500. Now you find that 8,400 is a better level to buy. And like you, there are many informed and prudent investors who feel that 8,400 is the level to buy. So what would happen? You would put in your order at 8,400 and wait for the market to come there. Now, when the market comes there, your order is already there. And as I said, like you, other prudent investors also have their orders put in at 8,400. Now, whoever is trying to sell at 8,400 will always find a order on the other side to buy. Now, if the sellers are not in great numbers or not very aggressive or maybe tired after a 100-point down move, what will happen? They will not be able to take out all these limit orders placed by you and people like you at 8,400. And then market won't be able to break 8,400. In fact, what people will now perceive is that all the supply is getting absorbed at 8,400. It means that 8,400 is an important support level. Now, this 8,400 may come from a technical support. It might be a market profile reference, whatever it is. But this particular behavior can be observed from an order flow chart. So whenever you approach an important support or resistance, you can observe whether these limit orders are taking the other side of the aggressive orders or not. And it is expected that like you did your research before putting in an order at 8,400, others also have done their research. And that means that that level has got some technical backing behind it. And since informed and prudent investors or traders are on the other side, then it means that that support is likely to hold. People will perceive this and then they will also start buying. Anybody who is still short going into 8,400 will feel that, oh, this support is holding, I have to cover my positions. So what will happen? Because of these limit buyers, the support will not get broken, and now everybody will turn the tables and try to be on the buy side of the market, and the market goes up. So this is how limit orders, what you can say, perform in the market. Then there are passive orders. I think they are better explained on the next chart. But let me make one thing clear, that it is the interaction of these order types which gives us a sense of what market is trying to do. Now, how the market orders, limit orders, and passive orders interact at different price levels will decide whether that particular support or resistance is going to hold, whether the market is going to continue its original direction, or whether it is going to change the direction. So this is a chart for passive and limit orders. The limit orders are shown in blue, passive orders are shown in orange. So as you can see, this is the current market price, around 8,500. And as you move away from this price, you can see that the blue bars are becoming shorter and shorter. Now, why is that? Because we know that as the probability of prices going away from its current price reduces as you move further away from the price. Now, in this example, it might not be very correct because 8,500 and 8,510 is the outermost limit. But suppose this was 8,600 and this was 8,400. So in a day, prices moving away from 8,500 so rapidly are very low. So limit orders are usually stacked. They'll be maximum around the current market price, above and below the current market price. And as you go away from that, they will reduce. Passive orders are something which are not yet in the market. So when these orders are not yet in the market, what will happen? Suppose I am ready to sell Nifty at 8,510. So what happens as the market moves away from its current price, the interest for buying and selling will increase. So if it moves higher from the current price, suppose 8,500 is the current price, you go to 8,550, 600, then sellers would be interested in selling that price. So when the price is at 8,500, selling interest will be maximum away from the price at 550, 600 levels, and buying interest would be maximum at 450 and 400 levels. And that interest which is not yet in the market is called as passive orders. Now you might be asking, where are the aggressive orders? Now aggressive orders are market orders, and those will always come above and below the current price. So now Nifty's tick is 0.05, but it's not always that Nifty trades in those ticks. So we might have a seller at 8,501 and a buyer at 8,499. Now, if these are limit orders, of course, now if someone is willing to sell at the market, he will sell at 8,499. So that aggressive order is not yet in the market, but when it decides to buy or sell, if he wants to buy at market, he'll buy at 8,501, and immediately that order will get reflected on the order flow chart. If he sells at 499, that aggressive sell order will be reflected on order flow chart. So we can only show limit buyers and sellers and passive buyers and sellers. Aggressive buyers and sellers are always clustered around the current market price because they are interested in that particular price and they want to get into the market. Okay. So these were the basics which I had to cover so that when we go into the examples, you should have some background of what exactly is happening and why I am saying something and what it really means. So moving forward. So how do you time a trade using order flow? That is the whole objective of this presentation. So there are 4 steps. First, you identify an important support or resistance on the chart. Now, it might be traditional technical analysis, a trend line resistance, a support or resistance, a moving average. Most of the investors, they are tracking 200 DMA. For swing traders, you use a smaller time frame and smaller moving averages. Then there are patterns such as I have covered all these things in my first presentation. So first you have to arrive at a level which should act according to you as an important support or resistance. Now what happens after that? Then we identify in context of that support and resistance where the smart money and the not so smart money might be present. Now I was in the latter category for most of my years, but I am hoping to get into the first category of smart money. So you have to identify at what levels these smart traders would be interested in the market in buying or selling, and at what levels they might not be interested in buying and selling. And many a times what happens is that smart money more often than not takes the other side of the not so smart money. So whenever people feel that okay, this is a good breakout and they are buying the breakout, more often than not what is happening is that smart money is selling into that breakout. Now people think that price has broken out, it should move, but suddenly the price stays there for some time and suddenly it collapses and goes back through the resistance from which it broke out. This happens because the smart money was taking the other side of that trade. So you have to identify where these guys are, because you cannot trade against these guys. It's always better to join hands with them and not join. If you cannot join hands with them, at least be what you can say eager follower of the smart money to avoid getting into wrong positions. Thirdly, we identify where limit and stop loss orders might be residing. Now, limit orders and stop loss orders are what are used by this smart money to get into positions. Now, how exactly they do it, we are going to look at it in detail. Uh, but beforehand, before a price reaches a particular level which interests you, you should be aware of these stop loss and limit orders, where they might be and what effect they might have on the prices. And lastly, you have to try and think like the smart money and then develop a strategy to benefit from the first 3 points. Now, if you think like a not so smart money and try to use the first 3 points, they are more than likely to mislead you. But you have to think like smart money, whether the smart money is interested at these price levels, what they might be thinking, what factors or market events they are looking at, and then use the first 3 points to develop a strategy that should keep you on the right side of the market most of the times. Now, it is not possible to be on the right side always, but what you can do is try to be on the right side more often than not, and then control your risk to be profitable over the long run. So these 4 steps we are going to use to time the trades using order flow. So let's just take an example and see how it looks on the chart. This is the recent price action. If you are aware that we had this big consolidation, I have already marked it on the chart. Went for 6-7 days, then we broke down, and then we went up. So this is the price action which we are going to study in detail, look through a microscope, and try to find out where exactly were the points where buyers or sellers were stepping in, and what were the ploys used by smart money to accumulate their positions and trap most of the people on the wrong side of the market, and then move the market sharply, so that those who are left out become anxious, those who are on the wrong side, they run for cover and help the price in moving in the direction they intend to. So just look at this first part. We had a nice breakout, a nice move, then we had 4 days of consolidation. Now, when you have a 4 days of consolidation, what you call this in market profile terminology is a balance. And whenever you have a balance, you have a clear-cut strategy to sell at the top of the balance and to buy at the bottom of the balance, all the time monitoring whether the prices are likely to break out or break down from this balance. So what you do, you sell here, you buy here at the lows. If prices break out, you monitor for breakout and then join the breakout. If prices break down, you monitor for the breakdown and join the sellers. Now, it might well happen that prices just break out of the consolidation and come back again. Here also it might break down and come back again. So you have to monitor for continuation. How we do that, we'll see in a while, and see if this breakout is for real, and are the sellers coming in below this balance or buyers coming in above this balance. So let's take this first day. We had this 4 days of balance. We opened almost inside the balance and rapidly moved to the edge of the balance. Now this is the area where you have to monitor whether this breakout is going to continue above or fail like it did. Now, if this is a balance, buyers and sellers are matched, and we do not have a single party exerting more pressure, then it is very likely that this balance should continue in the coming days. And whenever this particular likelihood is there, smart money is not interested in buying at higher prices. They will always buy at lower prices. So whenever in relation to past few days, the price is at higher levels in relation to these 4 days of balance, we are at the top of the balance, then it is more likely that smart money will be on the sell side instead of the buy side. Now, those who saw this sharp move higher and then thought that, okay, the price is now just going to move and not stop at all. They came in and bought here, but guess who was selling to them? The smart money. And as soon as these buyers got exhausted, because these are not since they are not on the smart side of the market, they also do not have much capital. So they went and bought here. Smart money was continuously supplying. These guys got exhausted and the prices promptly moved low. Now, whenever we have a failure of this kind at one edge of the balance, more than likely the prices will explore the opposite end of the balance. And that is exactly what happened. Prices just came down, and this time they broke down from the 4 days of balance. Now add these 2 days also. So we are basically breaking down from a 6 days of balance. Now, as per market profile, if you can see, this is a B shape, and we have already discussed in our last presentation that P and B shape denote old business, and we do not break out or break down from supports and resistances with old business. We require new business. And where was this particular B shape forming is also important. It was forming right in this support. So this we have already covered. So this B was not able to take out this support. What the smart money did, they accumulated their positions in this region. Now, how can we say that? Of course, not by the follow through, because if you talk by looking at the follow through, when will you enter the market? So you are supposed to enter here. But what smart money did, they entered the prices. Some eager buyers were also tracking the smart money. They also got in. Now, when these, not so smart buyers get it right, they cause a problem for the trend. How? They bought here, you get higher prices, they immediately start selling, panicking, and they are seeing profit after a long time, so they just want to book it. And what happens? This particular action creates resistance to the prices moving higher. So smart money, what it does, they let them accumulate along with themselves, but then mark the prices down sharply, hit their stop loss, and then move up again. So this is how smart money works. So when I said you have to identify support and resistance, this was my support. And this 4 days balance had higher and lower range that were my supports and resistances. I found out that smart money is less likely to buy at resistance at higher prices, and I was hoping for this particular breakout to fail. It failed. We came down. This was a bit dicey because we broke the support and we had some acceptance. So this is generally according to market profile, it means that this price is now being accepted, and this might lead to further continuation down. But once we go into details and watch the order flow chart, we get a different picture. So that is why it is very essential to have order flow along with your market profile to get a better view of the market, to get to go even one level deeper into the market profile charts and see exactly what is happening, whether buyers are causing any price move or sellers. So this is how the smart money will keep trapping you out of the market or hit your stop losses and then make the prices move. So I think the 4 points are well illustrated on this chart, and now we'll move forward. So let's go shopping is how I have named this particular slide. And I have to make a distinction between long-term strong smart money buyers against the short-term impulsive buyers who always tend to get it wrong. So I have taken 3 examples. Might seem funny, but what's wrong in having some fun? So suppose you are in a new city for an important meeting, and an hour before a meeting you realize that you have the suit but you have forgotten the tie matching to the suit. So what are you supposed to do? You will go down to the lobby, ask the hotel manager for a shop nearby, you'll rush to the shop, get your tie, won't even look at other things, and rush back to the meeting. That is what you're supposed to do. Second example, now I hope There are a few who still have girlfriends. I'm married. So suppose you go out with your girlfriend in a mall. So what is likely to happen? Most probably very few shopping, but a lot of time will be spent just meandering around, window shopping, looking at different shops, what they have to offer and all, and nothing real is being done. So that is most of the time what happens. Then the third example is an important one. Suppose there is a marriage of a family member, and you have to do shopping for the marriage. Now in India, this is a very big deal. People go crazy when they have a marriage, and they go even crazy when they are going to, do shopping for the marriages. So, days are spent in those shops, and a lot of buying is being done. So many things are bought. So why I'm saying this is because these three behaviors is exactly what goes on in the markets too. Now I have asked a question, which of the above is likely to take more time and money? Certainly the first one is not very costly, but at the same time you won't bargain for the cost of the tie either, because you don't have time. So you'll just go buy your tie and get out of there. So even if it's a 300 rupee tie and the shop owner sells you for 500, you're going to buy it because you don't have time. You have no time to bargain or think. Second might not take much money, but it will take a lot of time. And the third one is going to take more money and more time. So if you want to spend more money, you will require more time. And how that is reflected in our particular trading examples, we'll see in a while. So just remember these three types of shopping, and I'll relate it as and when we go into the examples. So I think let's just go right away into the examples. Okay. So let me just, it's a bad habit of mine to always put in context first. So I'm doing it again here. Let me just show you what exactly are we trying to do or going to study. So this is the recent market action. Everybody is aware we had a nice down move, and we tested the Brexit low here first time, moved higher. Now, as you can observe, when we were testing the Brexit low, the volume was very high. When we moved away from that volume higher, that price level higher, the volume dropped. We again came down. Here, the buyers were unable to take out this gap resistance. Then we came down. Yeah, this is the Brexit low. This is the gap resistance. And again tested the Brexit low and this pivot low or swing low, whatever you call it. Now, when we were testing this low, the volume dropped, as you can see, and then the prices took off. First resistance prices faced were at this gap resistance. And what we did, we consolidated there for 4 days. Then we broke out. Again, we go higher. Again, we face resistance just below this gap. Now, these are important references on a chart because gaps represent excess according to market profile. So these were the points where sellers were really aggressive. And to take out these aggressive sellers, we had to spend some time. So what is common between these two balances is this is nothing but absorption going on of the selling which happened here. So we again had a small balance which we just saw, broke down, could not find anything. Again, we moved higher. But this time we had absorbed all the selling which happened here. And this sellers trying to defend that price level were selling again, and their second time which they were selling was being absorbed by patient buyers, and they bought. They tested down whether we have anything on the downside, found nothing, and then they rapidly move higher, and we have some 350 points move in a matter of 3-4 days. And while doing that, we took out some important resistances. We took out this gap top, then we have taken out this particular what you can say swing high, again with a gap, Now we are resting just below this particular swing high. Now I don't know which resistance is going to hold, because if this particular resistance is supposed to hold, why not this resistance? Why not this gap? Why are we moving higher? Now we have to see inside this by using profile charts to get a context, and then further inside that by using order flow chart to get our timing right. So let's move on. Yeah, so this is our the same daily bar chart. Now I am showing as monthly profiles. So what is happening here? We have a nice B shape. We have discussed already. Sellers were aggressive here. B shape suggested that this was long liquidation, not new business. So promptly the price was marked back up. We stopped here. There was a gap resistance here. Then again we moved down, tested this low and found nothing below it. So reversed. While reversing, now this particular market profile charts highlights the balances better than a bar chart, but it's the same information essentially. We have this first balance here, second here, and the third one here. So as I mentioned, these two balances were showing absorption and absorption of sellers at earlier resistance zones. Now this particular absorption can be spotted on an order flow chart. How, we will see in a moment. And is there a clue which tells us that this particular buying is strong and the buyers clearly have an upper hand by looking at just at this particular profile chart? There is a clue, and the clue is simple. This is the first balance. We move higher. Second balance forms and is not able to come down inside the lower balance. So we could not come down here, even test what is happening here. The buyers were so persistent that they just push the prices up again. Okay, we get another consolidation. Again, we try to come back, but do not enter this lower balance. So as long as we are forming balances away from each other in a single direction, that trend is going to continue and is going to accelerate at some point in time, which just happened here. And these are the two potential targets I am looking at. One is being taken out already around 867080 range, and the second is this one, 8800. So I mean, I'm not going to discuss this what market is going to do here, but this is the context and this is the behavior which you have to remember and keep in mind when you are studying the smaller time frame profile charts and order flow charts. So move on. Okay, so this is where our example starts. Okay, so this was the day. Let me just go back and show you one more time. These 2 days, the first down day and this one, let me mark it for you. Yeah, this one. This is what we are going to study in detail. We'll look at a bit of background and bit of this action which happened post this to get some idea as to how we can use order flow. And I am using market profile to provide context for me. So let's start. So this was that first down day. And as I mentioned, how did we come down? Initially, we came down with intent, sharp down move, but then we started consolidating. And the combined shape was a clear B shape. Now, what does this price action or this particular market profile pattern tells us? That opposite activity is now becoming stronger and it is stopping your initial trend which was down in this case, and there are buyers coming in at lower levels and they are just accumulating from these aggressive sellers. Now you have to have some context behind it, because not every time do we get a B and P shape and reverse. But what is happening here, we have just broken out of a consolidation range, and that too against the trend. The trend was up and we are breaking out against the trend, and we are stopping just above this 8350 important support level. And we are seeing a behavior where it tells us that buyers are coming in and absorbing from these sellers. So that is what prevented from this particular profile from elongating to the downside and continuing this downtrend. So unless and until we get elongation, we cannot say that the trend is going to continue. In fact, the trend is becoming weaker and weaker, and this particular shape is very unlikely to get us beyond this particular support. So what happened on the order flow chart? So this is the price action in the later part of the day. Let me just go back. This particular area I'm talking about, this area. This is the area we are going to look at in detail on an order flow chart on the next chart. Okay. So what is happening here? You can see that sellers were strong. This was the rapid move which we are talking about. Now prices coming down with such speed and good volume always says that we have a habit of assuming that good volume means that the price trend is going to continue. Now even after looking at order market profile charts, you have to spend time to come to a conclusion. Whether buyers are going to stop that particular price action is not evident right away from a market profile chart. And what do? We use order flow for that. How? See, this was the first sharp down move. You can see most of the prints are red, and you then get a big, there is nothing in this region. So some of the stop losses were being hit, and suddenly you get a big number here. Now I have just narrowed this chart down, but this should be 1,72,100 and something. So more than 170,000 was traded on the sell side, mind you. Then what happens? Again we go down. Now we have a mixed prints, few red, few green, and again the same phenomena. Now this is in excess of 280,000 traded at this particular level on the sell side. And then we have the not these big numbers, but similar kind of behavior happening all through the chart in this whole region. This whole region. So what do we have? We have deep red color boxes on the order flow chart. We have initially strong red prints, which indicates selling, of course. And then we have mixed prints. Also, you can see these prints are a bit dark, but as you move to the right edge of the chart, the color is fading, and the color combination is such that whenever there is aggressive selling, you get deep red color. Whenever there is the selling is not that aggressive, you get faded colors. So what is happening here? We talked about these limit buyers, right? So smart money has identified that 8350 is not likely to break, because they feel they have already bought in that region and they feel that it is going to be defended. And who is going to defend? They themselves are going to defend, because they are the guys with more understanding and more money. So what they do, they put in big limit orders here, here. This is also 139,000 buyer here. So they have put in limit buy orders at these levels, and when the prices come into that zone, people's stop losses are getting hit, and all those aggressive sell orders are being absorbed by these limit buyers. Now these two are very big, and once they have broken the momentum of the initial down move, which is visible from these two orders, then they go on accumulating their positions, but not as dramatically as this. So the moment this happens and price starts moving sideways, buyers also become the sellers also become cautious that okay, we might now not break this support, maybe not today, maybe tomorrow. So they also become less aggressive. But now smart money is slowly buying into these prices at lower prices. The momentum sellers which were late to the party, they come and they keep selling, keep selling. They are expecting the price to continue. We have broken from a 6-day range. We have a breakdown. This is going to continue. This is now going to fall 1,000 points. Everybody is selling, selling, selling. They don't want to miss out on the down move. And guess what? Who is buying from the other side? All these blue boxes show that smart money was accumulating all this time when the weak sellers were selling. Then what happens? Again, we come back to the same market profile chart. We will just confirm our context and again move on to an order flow chart. So what we saw was, indeed, this particular this particular selling was being absorbed by smart money. Now we cannot be sure on this particular chart. We don't know whether after this price action we are just going to continue down, because it happens. But when we look deeper inside the order flow chart, what we see, there were buyers coming here, buyers coming here, and all through this range in smaller quantities. And they were coming in what form? Not aggressive buying. They were coming in the limit form. Their orders were there in the market already. When these aggressive sellers just kept on selling and they were hoping to break this support, they were patiently accumulating on the other side. And they had accumulated most of their position during this consolidation. And that is why, market profile tells us that whenever you see a B shape, it is not new business. New business in down direction. But this is new business in the opposite direction, and it is not aggressive. They are patiently, proactively buying in the market by putting in strong limit orders. But where? That is the most important thing. Just about this important support. And why is this support important? There is a market profile context behind that. I have discussed it time and again on the Slack group and my daily reports. But this was important. We came down here with a B shape as it is. Just looking at the market profile chart, I am not very confident of breaking this. I also mentioned that on my reports. But looking at the order flow chart, it now becomes almost confirmed that there is some strong buying going on here. And then what happens? Next day opens lower. Now, as I said, some weak buyers were also buying here, and smart money don't want to carry them. So they just flush them out by this particular opening down, testing, going down a bit, finding nothing, moving higher. Now, when I say finding nothing, what exactly do I mean? What did they not find while going down? And why did the price reverse? So this chart will tell us what exactly happened. Now, this was the earlier day which we studied. This was that 140,000 odd buyer, the last big buying scene. Actually, this coming on the selling side because sellers were aggressive, the limit buyers were accumulating. Now, what happens? All this area, there was some limit buying by the patient buyers, and they don't want to carry weak buyers if at all they had accumulated here. So what they do, they open lower and they go down. But as you can see on this chart, there is nothing printed on the lower side. All zeros. Means that there was no interest here. But as soon as people see, oh, there is a breakdown, they come in and sell. Sell, sell, sell. And what happens? Again, the smart money is buying. Now you won't usually see big numbers. You might have seen a big number over here. If there were some more stop loss orders lower, you might have seen a big number here on the sell side. and nothing on the buy side. Because again, some eager buyers were trapped. They had their stop losses here, limit buyers coming here, making them hit their stop loss and accumulating in that fall. But there was not even that. There were not enough stop losses even at lower levels. But just by opening below an important support, sorry, smart money created an illusion that this down move is going to continue. So what happened? These trapped buyers, they came in to sell. They thought, okay, the down move is now going to continue. I better get out of my position. Some small stop losses around this were hit. And what happens? Smart money just accumulates in this area and we continue the move higher. And as you will see that earlier part of this bar has only green prints, very little red prints. Again, you have some selling coming in as we move higher. Because now people feel that, okay, they had broken the support, they have come up, but again, we are away from the fair price. So let us just sell. Now, this particular action and some more points here also going ahead, that will tell us that why these bulls are doing what they are doing and how the sellers are getting trapped. So this was the failed breakout, as you call it. They tried to break down and they failed. Now there is a terminology in market profile of failed auction. This was an auction failure. We tried to auction below an important support, found nothing and went back inside. This is definitely auction failure, not the regular one which we get to see on social media or videos, but this is a plain failed breakdown, nothing else. And that is what an auction failure also is. So let's move on. Okay, now we come to the interesting part. What we did, we broke down from this support. We saw an order flow chart that there were not even stop losses below. So there was nothing here, no business to be done in this area. And when there is no business to be done on the lower side, definitely prices will move higher to find business. And that's exactly what they did. What they did, as they could not find anything below this level, they moved sharply higher, very sharply. But again, you get this familiar P shape. Why is this happening? Why did the P shape happen? We know that P shape happens when there is some patient selling going on. But again, as I said, the context is very important. We can safely say that some patient selling was coming here and now it is expected that the price should move down. But what do we expect? If selling is coming here, smart money is selling, we should move sharply lower and at least test the open of the day or better yet the low of the day. Because if this was emotional buying and this is smart money selling should trump the emotional buying and it should come down through the open and through the lows. But what do we get here? We come down all right, but we have a B shape. B shape suggests that now it is again conflicting. Now here we were supposed to have smart money selling, but now we have structure telling us that smart money is not selling, it is buying actually. So who is correct and who is going to be trapped here? So before this price action could occur during this particular day, we were not sure whether the price is going to follow this path or this path. So now we have to again go back to our order flow charts and look into one level deeper again to see what the smart money was doing when it was forming this particular B shape and why this P shape was not what it is usually supposed to be. And one more thing about follow through I need to mention. Whatever pattern you form in market profile, be it a P shape, a B shape, or a trend day or a double distribution day like this. So point for discussion on another day. But whenever you form a pattern, any pattern in market profile, what is the most important clue is follow through. So if P shape tells you that smart money is selling, it should get follow through down. If it does not get follow through, immediately you should start doubting the intent of these sellers. If you get a B after selling, the intent of these sellers is doubtful. Now you have got a B, it means that smart money is buying. What you should see? Follow through. And did we get that? Definitely we got that. And hence this was not the smart money, but this was the smart money which was accumulating. Now again we will go back to the order flow chart and let's see what exactly was happening. See, this portion is, this area is highlighted here. So what is happening? We had a P initially in the day and now we are coming down again. Again the same pattern as if you can observe from the first day which we saw. Big selling prints, red prints, price being marked down sharply. Again we start seeing these high numbers, 72, 83, 62, 97, 68, 67. What is happening here? The same phenomenon. Smart money is accumulating from these aggressive momentum sellers who, after seeing an initial breakdown from the 4-day range and then again a puncture of an important support, now they feel that in the second go we will be breaking this support. And smart money wants the same thing happening. They want these sellers to come in and sell aggressively, blindly, so that they can patiently accumulate their positions. And this is where the real buying takes place. Now we have smart money innovating in the markets. It means that they are always present at the change of the trend. But whenever there is a secondary test where even the smart money is assured that, okay, we are just testing, these weak players are not going to able to break this support, this second time when the market goes there and a test forms, this is where the real buying takes place. And if you can see this kind of behavior on the second attempt to mark the prices down, then you are very, very sure that this is going to be a potential reversal. And this test confirms. Now it depends on what time frame you are tracking. We are looking at daily profiles and 15-minute order flow charts. So the time frame is pretty big. At least swing traders are active in this time frame. So you will get a corresponding move out of this particular pattern, which we got around 350 points. Now I did not know whether the market is going to move 350 points for sure. But when I see that an important support is not being broken and such kind of accumulation is going on, you can be sure you will get at least a good bunch out of the market by being on the long side in this case. Okay. So the same patterns again repeating, same kind of accumulation which we saw on the earlier day, same thing repeating here. And then what we get? We get a nice follow through move on the same day. Let me just mark it. So this was the P which we talked about. This was the B where the sellers from earlier here could not cause an elongation and continuation. In fact, some buyers started showing up here. Now we have to monitor for their continuation, and what do we get? A nice move going right up and closing at the edge. When we close at the edge of any day, we have to see what was going on during the day. Firstly, we had this initial selling. Now this close here puts these sellers under pressure, because now either their price, whatever they sold at, is there. So they are either break even. If they sold any lower, they are already under. This B, there also momentum sellers were selling. their side, other side was taken by patient buyers. So all these sellers also are now under pressure, and since the market is closing, they can do nothing about it. So some of them covered here, which caused this move, but not everybody could cover, or they thought that okay, the price now will take resistance and again come down, whatever their analysis was. But the structure was showing that smart money was accumulating. This selling, which was supposed to be smart, could not gather any follow through. So now we have sellers under pressure by the position of this close. And whenever there are traders or one side of the market which is under pressure and feeling trapped, it usually gives to gap moves and sharp continuation in the opposite direction. So sellers trapped here, and next day we open above, a gap up, try to move down, do not even reach this particular okay, sorry, no, we gap up, we try to enter yesterday's range, and again we find nothing and we go higher. Now once we go higher, you can see this P shape here. There was a P shape here, again we have a P shape here. P shape indicates old business. Here also it was old business. Smart money selling, smart money selling. But what do we expect? Follow through down. Did we get a follow through in this range? Yes, we get. But what happened? Buyers again showed up and made this shape a B. What happened in this case was we get a follow through in the opposite direction. So buyers are not interested in coming down and accumulating again, but they are now just going to push the pedal and take prices in their direction. And what does this particular spike, as we call it in market profile terminology, what does this tell us? That we are moving away from day's value. This is the area where maximum trading was happening. Now we have moved sharply away from it. And where are we closing? Like this close put that day's sellers under pressure. This was happening above that 6, 7, 8 day range. So this close was putting everybody selling in that particular range under pressure. Now this particular behavior got us a gap up and higher move. So expect what this particular behavior will get. There was every chance that we will open higher and continue. And that is exactly what we got. Now we saw absorption or accumulation in this zone, accumulation in this zone. Now let us see if we can find anything on order flow chart for this zone. So I hope it is clear. I'll just move forward. So the P part, the loop of the P is this area. Now again the same phenomena. So even though we say that market, the history never repeats and all those cliches are there, but I find it repeating time and again. Same thing, buying, but by limit orders. You can see very little aggressive buying is happening here, because there are no strong green prints, but only strong red prints. Now red prints means selling, as we have been told. But what is happening? Selling, 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 again selling, again selling. Now a big 2,70,000 number on the sell side. Now if this was all selling by smart money, they should have gotten some follow through. Maybe not change the trend, but at least test the open for that day or trade into the single prints for that day. But we got nothing of that sort. We could not come down. In fact, what these smart traders which were buying in fact did, they accumulated this short-term selling and then they moved higher in the form of a spike, which we saw on the earlier chart, and put everybody in this zone under pressure and made them cover their stop losses. Their positions hit their stop losses and we had a sharp move higher. So this is how smart money operates, and this is how generally what you expect to happen in the market does not happen. but we get an opposite response because we are not looking objectively at the information. Just because there was a P pattern in this chart, it does not always mean that even if there was some selling going on here which was stopping the up move, it does not necessarily mean that we will always get the follow through that we want. And what does not happen in the market, in this case this particular down follow through, also tells us a lot of things about what is happening in the market. So if smart money is not able to push the prices down, then it means that there is a higher time frame who is accumulating these positions, and they will likely move the prices higher. Now, this might seem a bit confusing and also out of the scope of this presentation, that here also there were smart money selling and here was higher time frame buying. Now, for each time frame we have smart and not so smart players. So in this case, a lower time frame smart money was selling, but a higher time frame smart money was buying. So higher time frame always trumps the lower time frame, that you should keep in mind. And that is exactly what happened here. So let me just put this whole example in context once again for you. This is the combined 8-day range which we have, which we studied so far. And what happened during this range, that we have a nice gradient, and whenever we get a gradient like this, it means that there is a lot of effort from that side. So a gradient at the top means that there is a nice selling effort going on in this region. And once again, just because there is an effort does not mean that prices will follow, but this gradient was supposed to move the prices lower and find continuation. We did get a move lower, but what happened in this region was exactly opposite. As we saw on the order flow chart, all those accumulation on first and second day happened in this region. And then what happened? This region, we had accumulation, we moved higher, and we closed at the edge on day prior to this. Next day we gap up open. We do form a P, but just look at where this particular balance or acceptance is forming in relation to the composite profile. If you look, this is the composite value area, and initially we had accumulation below the value area. Now this is an expected buyer behavior. What do I mean by that? Smart money is expected to buy low, but low in relation to what? In relation to the recent value. So this was the recent value. We were below the value. Smart buyers were expected to buy. They bought. Then we move higher and go above the value. Now here the smart sellers are expected to sell, but since we are not getting any follow through lower, it means that the higher time frame is now done with this particular balance, and we will now move out of this balance. And that is why this particular accumulation was happening above the value area. And whenever we see buying above the value area, it is an unexpected buyer behavior. This is also referred to as initiative buying activity as per market profile. So we got accumulation above the value area, higher time frame buyers making it very clear that they are not interested in lower prices. They want to go higher because they have accumulated their positions, and we get this spike. Generally, if we had opened inside the spike, we could have traveled back down to this point of control. But since we gapped up and never even tested the spike, we got a nice move higher. And everybody is now aware that for the recent few days, we are having an incessant move in one direction. This was a nice trend day, 25th, and we moved higher. So this was the example where I wanted to show you how you gather context from market profile and use order flow to confirm your observations. Now let us just look at how you can enter a position using order flow. So what are the ideal entry points? or how can you spot an ideal entry point? First is, that's why we are going to, make this presentation available for you so that you can digest the information and ask me a lot of questions in the Slack group. Okay, sorry for that. Again, moving on to the presentation. What are the ideal entry points? We use delta divergence to enter the positions. Now, again, I am telling you, this is going to happen every now and then. And if you get the context wrong, delta divergence is not going to help you at all. So you will be driving blind in the markets without context, and that too at full speed, and you are sure to hit something very big and then regret your decision later. So this is the 18th. Now 18th, let me show you if I can see 18th somewhere on the charts. Yeah, this was the 18th. Let me just mark it. This is again to just provide you context. This was the 18th, and we were at the top of the 4-day range, and there was a sharp move higher, but it failed and we came down. So this is the day we are going to study here. So this was this sharp move higher, moving higher, and just look at what is happening. I have marked it in blue. I'll just highlight it again. Lot of green prints suggests strong buying. Come to the top, you get big green numbers, suggests that now some limit selling is stopping the price from going higher. And whenever we move a lot of distance in a short period of time, it suggests that the move is likely to be an emotional response. An emotional response and not something which has the power to continue. Now, coming into a 4-day range top with a lot of green prints but wide ranging bars, we cannot short it immediately, but we have to observe what is going on. And what is going on? Did we see after these two big bars further continuation up? No, what we saw was a sideways move. So firstly, after these two bars, if you look at the delta figures, the net delta here was some 2,70,000 on this bar, green. But on this bar, it was only 5,250. So delta has dropped drastically. Does this mean that we will immediately start falling down? No. We move sideways. This confirms our observation that, okay, we are moving sideways. Again, we try to move higher on this particular bar, but again, you saw that delta did not move. It was only 8,850. Now, whenever you see this kind of divergence and have a context that we are into a 4-day range top, an emotional move before it, not gathering continuation, also showing some delta divergence, this is the time where you can initiate a position somewhere in this region. Now, you cannot pinpoint all the time, somewhere in this region, and put a stop here. That's all you can do. You can never be 100% sure as to when to enter a position and when not to, but when you see these kind of evidences, some delta divergence, emotional move, no continuation, sideways move, delta continuing to fall, negative delta accumulating, it means that sellers are getting heavy here. They are getting the better of the buyers, and we can now expect the prices to move down. That is exactly what happened on 18th. So this is how you are supposed to enter a position. But then if I show you only this chart and not the whole context which we studied for last 10 slides, then you are likely to just find these patterns. And if you just keep finding these patterns on your charts, you are likely to fail, because this activity happens all the time. Unless and until you are into an important resistance area backed by strong context, it is very dangerous to attempt to use only order flow to enter your positions. So you get the context right, you get the levels right using market profile context, and then use order flow like this to time your trades. Moving on. Now this is the 23rd and I have also included that failed breakdown also to give you some idea. Now what is happening? I marked these red prints, strong red prints on the prior charts, but now we will also look at the delta. And what is happening here? Now we had 1,14,000 negative delta on this bar. Immediately on the next bar, we make a lower low, but the delta drops down to minus 82,000. So what is happening? The delta is diverging. Again, we get some sideways move. Again, we get some sideways. So what is happening? This delta divergence is causing the price to move sideways. And then what happens? Again, we see some high delta numbers. And again, if you compare the delta increases on this bar when we break this down, and we don't have a delta divergence when we compare this bar and this bar. So what does it mean? Does it mean that this delta divergence has lost its effect? Not exactly. We have some divergence, some accumulation, but here we are still not ready to reverse. Whenever you see a higher delta number, no divergence when we break out, what it means is that you still do not have this accumulation completed by the smart money. There will be another attempt to break this particular low, and then maybe it will reverse. So what we do, since it is going right into the close, we cannot initiate a position on this day. Next day we break down, check the delta, minus 51,000 compared to 1,29,000. So now again we have second delta divergence. This time taking out stop losses of all the weak buyers in this zone. And then what happens? Move sharply higher. So this is how I prefer to use delta divergence, but without context, it is really difficult to, get into at right point in time. Okay. So moving on. So I hope I have covered. Let us just revise what we started out to cover in the beginning. We hope to identify where buyers and sellers might be accumulating or distributing in the markets, and we saw examples of buyers accumulating in the market. But we have to we have to be sure of the context. Without context, the order flow observations won't help all the time. Then we wanted to confirm our opinions, arrived at using TTA or MP. We did that. We saw that B shape showed us smart money accumulating, and we checked it on the order flow charts, and we saw that that was indeed the fact which was happening. We also saw how the buyers and sellers were trapped. We also saw a lot of times there was effort to push the price down, a lot of red selling prints, but prices not conforming means that the other side was the stronger side, and the prices promptly reversed. This also we saw. Then we wanted to find out some good entry points to create positions in the market, and we used delta divergence, but again to the point of sounding paranoid and boring within the proper context. Let me again tell you, if you get the context wrong, order flow won't help you. Actually, it will harm you. So that was the presentation. Thank you for attending. The next webinar in the series will be conducted on next Saturday from 10 to 12. and the topic will be integration, combining traditional technical analysis, market profile, and order flow for better results. So we will look at few examples where everything will be combined, which we studied in the last 3 presentations. Now let me tell you, you can get access to our Slack group. Please note down this link, www.belltpo.com/feedback.html. Please fill into this feedback form if you have not done already, and get an access to the Slack group where you can ask all the questions you want. Excuse me. The recordings for this webinar series will be available for a limited time, and we could not post the first 2 recordings, but we will be posting all of them on Monday, before Monday actually. So you will get all those recordings on Monday, and then you can refer to it. And these webinars will be offered free of cost for unlimited amount of time to Bell TPO customers, and any future webinars will also be available for them. The softwares used for today's presentations were Bell Market Profile and Bell Order Flow. I use them. I have been using them for a while now. They are really good. So if you want to pursue this particular path of analysis, I suggest you can go in for these softwares, and here are the discount codes. Those who are there in the Slack group will get this slide again. You can note down the discount codes. I will also have someone mail you the discount codes so that you get the exact number. But I am just keeping it on, and I'll try to answer the questions now. Let me see. I hope there should be many. Password, no. What does low volume areas help? Here at the top there is no volume 2. Yes, low volume is a sign that smart money is not present in the market. So whenever you are approaching an important resistance and the volume is dropping, it is another sign which tells us that the resistance or support is less likely to be taken out. So, okay, total it is, and I hope this answers your question. Data source, I use True Data. A lot of information to digest. Yes, I understand, and you have to go through the presentations a couple of times and be there in the market and watch the development, real-time development, to get an idea. When there is no business to be done at the low, how come it opened lower? Yeah, smart money does that. Definitely there was no business to be done, but how do you know there is no business to be done there? Smart money wants to be sure whether there is new business beyond a resistance or support, and you cannot be sure of that unless you trade at those levels. So when they gapped open the market lower and then found that there was no business to be done, they were sure that we can mark the prices in the opposite direction. So I hope this answers your question. Isn't it ORR? Opening types, it's not that simple, and it should not be that strict also. Opening types are there to help us, not cause more problems in our analysis. So it can be ORR, it can be open test dive, you can take it as anything. The B shape which gave an indication that prices won't move down further. Yes, it did not give the indication, but it alerted us to the possibility. There is a difference. Many a times you will get a B shape or a P shape and prices moving in the original direction. That happens a lot because again the context matters, and you have to get the context right, and also you can confirm this from order flow like we saw. Somebody was not able to listen. Yes, you will get the recording. For one, is it okay? Yeah, I agree. I think I cleared that point. That was, I think, during that slide. Prakash had a question, what about aggressive buyers here? And I cleared it then only. JD talks about a lot about poor low and poor highs, etc. Yes, you must have seen his presentations. JD definitely talks about those. But again, the way JD understands the context is, I think, above every one of us. Not relevant to, definitely relevant to our markets. Actually, it's not about markets. It's just that poor highs and poor lows, it's a two-edged sword. On one hand, it tells you that the auction is not complete and those poor highs and lows need to be repaired. And on the other hand, it tells us that you are coming second time at that level and still not able to take out that level. So sometimes it tells us that the auction is exhausted. So, these two are exactly opposite information pieces which you take out from poor highs and poor lows. So I think it is important to put this in context and not to just blindly follow poor highs and poor lows as it is shown. Uh, Yeah, there is a good news. Bell TPO has removed the password from the recording of the old videos. I am just putting in a link. This is the page where you will get all the recorded webinars for this series. And also, there is no password for the webinars of this series. And the first and the third part will be uploaded by Monday. One very basic question from Arjun: is volume profile different from market profile and order flow? Is it used differently? One simple answer: yes. So, yes. These, specific questions about poor lows and highs and everything which can be discussed in uh, on the Slack group better. Uh, so I hope if there are no more questions,